I will start recording. I hope that works. Welcome, Isaiah. Okay. Someone's talking and I couldn't hear exactly what was said.
Oh, that was me. I was just saying, hey.
Okay, great. All right. So as you can see from the review, from the announcement set out this morning, 2 review sessions, the other one's at 7 o'clock. I'm going to repeat the charts, but do them a little bit differently in terms of the numbers that are used, and then go through a different example. And the date and time of the final exam is either Monday or Friday of next week. So how do we do that? Well, how do you sign up for the exam? Let me get out of here and get over here. Stop that. There we go. If you go to class preparation assignments, I asked you to choose your exam date. Basically, it's a little quiz or something, and you just choose one of the date or the other. I'm not sure exactly how it works. You begin, and you get to choose one of 4. And one of them would say, you prefer to take the exam in year 2174? No, that's not the right answer. But if you could choose B, for example, you want to take it on Friday, you save the answer, and I guess you submit this, and press OK. And that's all it says, apparently. I thought there was some feedback to you. All right, so apparently not. Or maybe there is sometime later. We'll see. That allows me to basically email you the exam at the start of the beginning, and then you will upload it to Blackboard, and I'll provide the instructions in the exam on how to do that. What else was in this announcement? Just the meeting today. All right, so if we go here, the exam study guides, I posted the exam study guide. I also sent it out by the email this morning. And I made a couple of small changes to it as I've gone through it. All right. So this is the actual questions that will be posed on the exam. For the long essay question, you get to choose. I'll provide you 1 of 3 possible hypotheticals. And the charts will be different on each exam in terms of the numbers that are used. Right? I'm going to email you the exam. You'll have 2 hours to download it. You should save that file to your computer, save it periodically, so you don't lose your answers, and then you'll be submitting it by Blackboard at the end of the 2-hour period. And anytime during the exam, if you have questions, you'll be able to call me or text me during the exam. So a lot of points in this exam. Question and answer on the efficient high markets hypothesis, 56 points. 2 charts, 40 points each, and 210 points for this letter to the client. It's open book, open note, but I don't want you communicating with any other student during the exam, or if somebody takes the exam beforehand, don't communicate with them. You shouldn't need to. You should know everything that's going to be on the exam anyway. So the first question is to explain the efficient markets hypothesis. There are 3 versions of it. I'm going to come back to that a little bit later. And then we go to a chart, and this is the tax efficient asset placement chart. Now there is a video that's recorded on YouTube, and I sent out an announcement about that earlier, that basically goes through the 2 charts, but this might be a little bit helpful to you. Basically this chart, and it's going to be in this format. All right, I'm just going to fill in the numbers here for you across the top and to the side, and you'll be filling in all the yellow blanks here. So let me give you an example of that. All right, Spider-Man has 700,000 in her traditional 401k account. I guess it ought to be Spider-Woman. 100,000 in her Roth IRA account and 200,000 in her individual account. So I put those numbers here at the top, and I also put them at the bottom. And then I do an asset allocation for you. And this asset allocation might be quite different on each exam. These numbers will be different on each exam. And we had to go through the process of figuring out what goes where. The first thing that you do is you look to put the foreign stock funds in taxable accounts. And the reason for that is only if they're in taxable accounts, not tax-free accounts like Roth accounts, not tax-deferred accounts like traditional IRA, traditional 401ks. Only in taxable accounts do you get tax credits. So the answer to this one is pretty easy. You need $200,000 in these accounts, and you just happen to have $200,000 in foreign stock funds. So you just put that there. The second is to put all of your fixed income investments, in this case it's a taxable bond fund, into the traditional IRA or traditional 401k accounts. So we put 400,000 there because we have 700,000 available. The third step is to choose the asset class with the highest expected return that's remaining and put that into the Roth account. Well, we have $100,000 in a small cap value that's going to earn 11% or so. So that 100,000 we want to put there, and that fills up that asset class. And that makes it pretty easy to do the rest because we've already filled up 2 columns. So we just got to put the rest in the other columns. We don't have to go through the remaining steps. And just double check, that adds up to 700,000, 100,000, 200,000, and the chart is done. Any questions? Go to the chat room if you like, or just open your mic. All right, so let's go on to a different example.
Would you keep it? Could you scroll up just a little bit more? I'm just trying to see what those 2 columns are.
Yep.
Okay.
Traditional IRA account, which is tax deferred. You're going to be taxed on it when you pull the money out. Roth IRA account grows tax-free. So anything that grows tax-free, you want to grow the most, which is why we put the asset class with the highest expected returns in there. But first, we want to secure those tax credits. Those tax credits themselves could be easily worth 1 to 1.5% a year in terms of the return to you, depending on what countries they're invested in. So now we have a different example. All right. Here we have Spider Woman who has 300,000 in her traditional IRA account, 400,000 in a Roth account, and 300,000 in an individual account. This would be unusual for today's retiree. I hope that this is more common for in the future for those in retirement. I hope that people put more money into their Roth IRA accounts when they're young and in lower tax brackets and let them grow with the effect of compounding. So we need to do, the percentages here are different. So we need in the individual account, we need our foreign investments. So we have 2 foreign investments here. Each of them is 100,000. So we want to secure those foreign tax credits, and the only way to do that is put it in the taxable account. Then we have 400,000 of bond funds, but we only have 300,000 in this account. So we want to put 300,000 there. All of the interest income in that bond account is going to be deferred. You don't have to pay tax on it, at least for the extent of 300,000. Now we've got the Roth account, and we want to put our best performing asset classes in there, right? So we have small cap value, we have 100,000, but we need 400,000. We have the next best asset class is value stocks, that's 100,000. And then 200,000 from the large cap stock fund. It's only earning 6%, but that's still more than a fixed income. And in this case, we would put the fixed income under our rules here. Now, some people might argue, if we put the large cap stock fund over in the taxable account, that's pretty tax efficient. It has a very low turnover rate. It's not likely to distribute a lot of capital gains. Most of the dividends will be qualified dividends. If somebody said, I'm going to put 100,000 here, 100,000 here, and we're going to put the fixed income over here instead, I would accept that answer. There's different ways of doing this, but there's some logic behind that. At the same time, if you put fixed income over in the Roth account, it's going to grow a lot less, so you're not getting the benefits of that tax-free growth. When you defer long-term capital gains, when you don't realize them every year and you defer capital gains, you're eventually going to pay tax on them when you sell that asset. The only way you can avoid that under the current tax law is to die and get something called a stepped-up basis. But that's over our heads. All right. Any questions on this before we go on? Okay. So there's an essay question, but before we get to the essay question, I want to go back and address the efficient markets hypothesis. All right. There are three versions of the efficient markets hypothesis. There's the weak form, there's the semi-strong form, and there's the strong form. And the weak form basically says that past prices cannot be used to predict future returns. And what that means is technical analysis, which is basically, I'm going to come up and make a whole bunch of charts, so it's also called charting, cannot be used effectively. And technical analysis is still out there. In fact, I see articles about it all the time. I'll see on CNBC or Bloomberg, I'll see some technical analyst appear and start talking. And I completely dismiss them because there's really no academic evidence that any of these charting techniques, and there's hundreds of them, work, except momentum, which is actually one of the factors that we've studied. All right. So the weak form of the efficient markets hypothesis is strongly refuted by academic evidence. And in fact, most major brokerage firms do not hire technical analysis anymore unless they just really want people to trade a lot, because technical analysis will have people trade 2 or 3 times a year, and trading generates fees for them. Now, semi-strong analysis says all publicly available information is reflected in stock prices. Therefore, fundamental analysis, which is looking at the data, the announcements, the news, won't lead to superior returns. Now, we actually have a whole class on fundamental analysis. It's a class in which you basically learn there's 400 different types of data points that are used to basically undertake fundamental analysis. A lot of them are related to our factors, but basically the semi-strong form says that you can't outperform the market by using this fundamental analysis. Now, the semi-strong form also includes the weak form. So not only does it say this, it also says all of this up here. The semi-strong form is supported by a great deal of evidence. I think, in my own view, that high-cost active management, basically hiring somebody to go and choose stocks for you and paying them 1% or more, is basically a fool's game. You're very likely to underperform the market because of those additional fees and costs, including the cost of trading. Very strong academic evidence for that. there's lots of surveys done of active mutual funds versus index funds or passive funds. And the longer the time period you look at, the more likely it is that an index fund will outperform the active funds. And part of this is because of it's a zero-sum game. For everybody who wins, there has to be a loser. Right? So winner versus losers. If somebody outperforms, somebody else has got to underperform. But you also need to subtract the fees and cost, which means that there's going to be more people who underperform the market, especially if they're incurring large amounts of cost. And then we have the strong form of the efficient markets hypothesis. It includes the weak and the semi-strong form. But then it goes further and says that all private information is also reflected in stock prices. And what we mean by private information is information that CEOs and officers of the company have, and perhaps directors of the company have, and people that they tell this information to, insiders, inside information. Now, if you were the friend of a CEO and the CEO told you, next week, our company is going to come out with an announcement that says, wow, our new drug, the trials of it have been fantastic. And you go and you trade on that information. You go out and buy that stock. That's insider trading. You're not allowed to do that. Both the CEO who gave you the information and you who traded on the information could be charged with a form of securities fraud. But the CEO, unless restricted because of a stock offering or something, can trade on that information. The CEO could go out and buy stock. If they thought bad news was coming out, officers or directors, the CEO could sell the stock in the corporation before the bad news comes out. So we can watch these purchases and sales. They're actually required to be posted for a publicly traded company. We can watch them. They have, within 5 days after the purchase or sales, there has to be a notice posted with the SEC. And there are actually funds out there, investors out there who watch for these announcements and will trade based on them. And we can tell from the analysis done of all these announcements that, in fact, CEOs, officers, and directors who trade on their own information actually do, on average, outperform the overall market. The result of this is that the strong form of the efficient markets hypothesis is generally not accepted. So that's kind of my summary of these. There is of course, one of the things I posted in this document was all of the answers to the class preparation assignments. If we go way down here, here's the answers to CPA 1, CPA 2, and somewhere around, I think it's CPA 5 or 7 or 8, somewhere in there is the efficient markets hypothesis. You could search for it, and you would see some more about it at that point. So, questions on the efficient markets hypothesis?
No.
All right. We will go on then. Got 30 minutes to cover one of these examples. All right. So, the next question, and this is the one that has the most points, is one of 3 hypotheticals, and it's basically some changes are made to the facts, both by age and also in terms of the assets, net worth, and the like. All right. So we'll take the first one. Well, Diana, or Wonder Woman, is age 22. She just graduated from WKU. She's single. She has no dependents. She has a steady job. She makes $55,000 a year. That's a pretty good salary. Sharing an apartment with a friend. She has a cash reserve already in the amount of $5,000, sufficient to fund 3 months worth of her expenses. Boy, cash reserves have really become important, haven't they, after COVID-19? Most people live paycheck to paycheck, and having a cash reserve has become much more important. In fact, the savings rate in the United States have gone up from 6% to about 11% just in the past month. Your client has no debts, very fortunate. Saving $6,000 a year to purchase a Toyota Camry, not going to buy it on credit, which is a good thing. Plans to purchase it in 3 to 4 years and then own it for 10 to 12 years. Currently drives a 7-year-old Honda that her dad gave her when she was in high school. In addition to saving for the car, she plans to save 18% of her income. So she's actually, the car is an expenditure. It's not really savings, right? Even if you're doing a sinking fund for it, it's still an expense item. So she's planning to save about $10,000 a year. Of this amount, $2,000 will come from an employer match in the 401k account. That goes into traditional 401k. The remaining amount will be allocated between her Roth tax-free account, $2,000 a year, so she gets the match, and the other $6,000 will go into her Roth IRA account. A Roth IRA account has the same tax attributes, but she might have better investment choices there, and more importantly, that becomes like an extraordinary cash reserve account. If she really needs it, she can pull out what she contributed, not the growth, but she can pull out what she contributed at any time without any penalty or tax on it. So we want to use a chart to establish a strategic asset allocation for the chart, and then we need to explain it and why we did or did not include certain asset classes, all right? And explain why we used or did not use the Larry portfolio technique, which basically you have the principle of the Larry portfolio and you can apply that in different ways. So when dealing with a 22-year-old, I'm going to go down to the chart here. This is the grading rubric. We want to know that the equity allocation is the correct percentage of the total. So we want something that appears rational to fit this client. That the foreign equities are 30 to 50% of the total allocation equities, that the thresholds for rebalancing are correct, and the contributions to the portfolio returns are correct. And here is the table. Now, I actually had 2 of this column, this row, so I took out one of the rows. And I went ahead and put in some expected returns for these 2 asset classes before. I had put unknown there, all right? And we'll just go down here and fill this out for a 22-year-old. Anybody out there want to take a stab at this? All right. It's not uncommon to not be brave at 9:30 in the morning. So let's look at our asset classes. Large cap balanced. Expected asset class return 6%. Small cap value 12%. Foreign large cap balanced 8%. Foreign developed markets using size, value, and profitability factors 10%. Emerging markets using those same factors 12%. And then REITs, hedge funds, commodity funds, a corporate bond fund with a intermediate term duration, credit quality, which is investment grade but fair, a high yield bond, which basically has low investment quality, higher expected return, and then a U.S. Treasury bond, long-term bond fund, which has a duration of 18 years, and a short-term U.S. Treasury has a duration of 2 to 3 years. You will see different returns here. So let's first focus on the equity allocation. First off, we note that this 22-year-old doesn't own any real estate. And because of that, it might be a good thing to go ahead and put some asset allocation in there for this person. So I had already filled this in. I put 10% in there. If somebody said 20% real estate, that would be fine. All right. If somebody said zero real estate, I kind of wonder about that. Real estate is a different investment asset class. It has a strong correlation to small cap value stocks, actually, of all the correlations that are out there. A fairly strong correlation to stocks generally, but it does have some differences. And I think on the modern portfolio theory, when you have not perfect correlations, adding that to a portfolio, we also see that the expected return is a little bit lower than stocks, but the volatility of real estate investment trust is a bit lower too. So let's say we had a Great Depression and stocks went down 80%, 90% in value. We would not expect real estate to decline by 80 or 90% in value. It might decline by 50%, but probably not a decline of that. So it has some attributes of it that are less risky than equities, and the result of that is we get less expected return. Probably a good thing for somebody who doesn't have real estate to have 10 to 20% in their portfolio. And then I went ahead and put, let's see here, we have in US stocks, we have 30%, and here in foreign stocks, I have 40%. So that's not actually a good thing. I might change this around and put maybe 0% in foreign large cap balance funds and put 10 and 20 here. That way I have 30% here, I have 40% here. 30 divided by the total of 70 is somewhere between 30 and 50%. So I am within that 30 and 50% of foreign stocks as a total percentage of my portfolio. Now, this is using a big small cap value tilt, both here and here. This is using the size and value and profitability factors too, as this one is too. So that kind of looks like the Larry portfolio, other than this US large cap balanced allocation. Why? Because you're basically using the size and value factors, tilting very heavily to them. And then the idea would be to lower your allocation to equities. If somebody was 22 years old, you would say, hey, maybe you don't need anything in US Treasuries. But if you don't want to take on that risk, if you don't want to take on 100% risk, then you're a little, maybe your job is not quite as steady as it could be. You're not working as a professor, for example. Then maybe having 20% in safe investments is a good thing. I put ahead 10% in here, but one could easily say, maybe nothing here. With an expected asset class of return of 6%, which actually a lot of data out there shows that over the next 10 years, it will be less. Now, this is the 15-year expected asset class return that I typically use. But somebody might say, hey, I want 0% there, and I'll put more over here. Maybe I'll put more over here in foreign developed markets and go 10 there and go 0 there. And that really looks like the Larry portfolio right there when you do that. That would be fine too. But if somebody said, you know what, I want 10% in small cap in S&P 500, because there are periods of time when small cap value doesn't do really well. In fact, over the last decade, the S&P 500, even through the end of March, which is a dismal period, or basically performed about 9 to 10%. Small cap value here, at least in the US, did like 3.5% over the last decade. So there are some decades where small cap value doesn't do really well. Right now, small cap value is way undervalued, and large cap stocks here at the end of April, because large cap growth is so overvalued, which leads to their lower expected returns over the long term. So in today's market environment, I would probably use the Larry portfolio because small cap value is way undervalued. And I'd go ahead and apply that in all respects here. Well, that's my So I'd probably not put foreign large cap there, and I put 30, 10, 20, that's 60, 70, maybe go even 40% here, something like that. So now I have 80% locked up here, and then I have 20% US Treasury bonds. So why not these other bond funds? Well, in a Great Depression, corporate bonds are going to be under pressure. In fact, we've seen this here in the coronavirus crisis. Back in March, corporate bond funds actually fell in value, even high quality ones. Even though interest rates were coming down dramatically, 2% a lot of times, corporate bond funds fell in price. Short-term ones fell a little bit. High-yield bond funds fell in price by 10 to 20% because there's just a lot of default risk there. There's basically risk, the same type of risk that you get with equity risk. The company going out of business also affects bonds. Of course, if a company goes out of business, bonds might get a recovery rate somewhere in the 30 to 50% range. So you're probably going to get some of your money back, but there's still a good chance of losing money there in a Great Depression situation. And somebody might ask, are we in a Great Depression situation? Not yet, but we are certainly in the most significant recession since the Great Depression, and I'm counting the Great Financial Crisis in that. And it is entirely possible that we could be in an economic depression that rivals the Great Depression, depending upon how the coronavirus and our treatments for it and how fast we get a vaccine out and the like. I think right now the stock market is assuming everything's going to be good. There's a lot of what we don't know about the coronavirus that is right now. I think the stock market is just reflecting the best case scenario. So we don't really want long-term bonds because we have a lot of interest rate risk there. We may not want corporate bonds because of default risk. And we don't really like commodities. There are many, many advisors out there who use commodities. I'm not one of them. You can basically, the long-term rate of return of commodities is about equal to that of inflation. There's a lot of substitution that goes on with commodities. I think that's going to accelerate, especially when you have 55% energy-related commodities. Someone might say, because energy prices are so low right now, I'm going to go ahead and invest in commodities because I think energy prices are going to go up. And actually, that wouldn't be a bad bet right now, but it's a long-term bet. It's very, very possible that over the next 20 years, oil and gas products go way down and that the values, that the prices stay down. I think we'll have some volatility along the way. We also have a hedge fund as an asset class. 25% return last year. That sounds really good. But we know that the returns can go way up and way down with any of these investments. So you really should not be investing based on past performance. And it charges 2 and 20. So it charges 2% a year. Plus, for every year that that's profitable, it charges 20% of the profits. So we know that when you got that kind of expense, hedge funds are likely to underperform over the long term. There's actually a lot of different types of hedge funds, and we know from our studies that the research out there that has been done, which actually pulls together as much hedge fund data as they can, shows that in fact hedge funds underperform the overall stock market. They just tout it, and they look so attractive to a lot of rich people who like to invest in the next new thing and all that. They do have a little bit different correlation than equities. For example, during March, when the stock market, late February and March, when the market was down, we'll say around 33%, something like that, hedge funds on average were down, according to some articles, like 20%. I'm not sure they included all the hedge funds in that. I'm not sure how good their database was. But some hedge funds actually do hedge against the market. That's actually a very few types of hedge funds, but there's all different types of strategies there. But anyway, a 0% allocation of that would be correct. 0% here. If somebody said, hey, I'm going to put 10% there, and I think commodities are going to do really well because they've done really poorly over the last decade, and commodity prices are really low right now. As long as they explain it, I'd accept it as an answer. Corporate bond funds, if you were to do that, I want you to discuss the risk of doing that in some way. So I would be hesitant about investing in corporate bond funds and stick with U.S. Treasuries, and even then go short term and you would discuss interest rate risk. So basically, you're building the portfolio here. After you build this, you need to come up and do the lower and upper limits for rebalancing. Before I go there, any questions? All right. So lower limit for rebalancing, you can just write at the top of this, times 0.8. Upper limit times 1.2. So when you get to the exam, you can just go ahead and put that in there if you want. All right. And 40 times 0.8 is equal to 32 and 48. And then you come to 10, you get 8, and you get 12. You can duplicate this down here. And 20% times 0.8 is 16 and 24. And then you come down here to fixed income. And here you have a choice. You can do the same thing. You can do 20% less, 20% more, or you can do what Larry Swedroe does and what your professor has done. Following Larry Swedroe, when I read this in 2001, I go plus or minus 5% from whatever the fixed income allocation is. So this would be 15% or 25%. Either one of these is fine. Either approach you want to take. If you have a 50-50 portfolio and you're at 45 and 55, you're really trying to keep the risk of that portfolio between equities and fixed income. Most of the risk is exposure to market risk. So you're really trying to keep the risk of that portfolio in line. If you were plus or minus 20%, your rebalancing targets wouldn't be on a 50-50 portfolio. They'd be at 40 and 60. So that portfolio is going to have quite a bit of difference in risk if it was 41% versus 59%, which is, in my mind, the reason why Larry Swedroe went with plus or minus 5% for the fixed income allocation. And I think it's a better approach. Okay, and then we determine the expected contribution to the portfolio returns. We multiply 0.4. We take this column and convert it to a decimal times 12, and we come up with 4.8. 0.1 times 10 is pretty easy, that's 1.0. 20 times 12, 0.2 times 12 is 2.4. 0.1 times 7 is 0.7, and of course you could use a calculator to do all this. 0.2 times 2% is 0.4, and then you would add all this up. 4858, 6282, 8.9, 9.3%. That is your expected return of the portfolio, and that's the gross return, because then you subtract fees and costs, for example. You might also add a rebalancing bonus in. That's a pretty high expected return, but again, we use the Larry portfolio here. So when choosing asset classes to have pretty high returns, because when using multiple factors in these asset classes, we are tempering that a little bit with the real estate investment trust, a little bit lower return. We still have 20%, but we're still getting a 9.3% return. That's pretty awesome. That just shows right now, when I actually do the small cap value, I'm coming up with north of 12% expected returns right now. And I was on a seminar with Rob Arnott of Research Affiliates, and he was talking about emerging markets value being strongly correlated. And he actually has an emerging market small cap value fund, and he was looking at expected returns over 10 years of 14%. Of course, there's a big range in terms of what the actual returns will be. So What would you do after that? There's going to be space there after this to basically type your essay. You're going to explain your strategic asset allocation. You're going to explain your factors. So we have about 10 minutes here. Before I go further, any questions on this chart or how it was done? All right, thanks, Travis. Just one comment. If I keep this up by Christmas, I'm either going to be Santa Claus or a polar bear. We'll see. All right, so I would explain the portfolio like this. Dear Diana, thank you for being a client. I would like to explain the portfolio that we constructed for you. We are using carefully selected asset classes, and we're using multiple factors. We know, for example, that over a long period of time, 20 years or more, there's an 80% or greater probability that value stocks will outperform growth stocks, that high profitability stocks will outperform low profitability stocks, and that small cap stocks will outperform large cap stocks. So I've covered all the factors right here already. All right. I would then explain what a small cap stock and a large cap stock is, because if you just say we're investing in small company stocks, somebody might say you're investing in that mini bar down the street. No, small company stocks are worth typically between $40 million in publicly traded stock versus up to 2 million. Large cap stocks are 10 million or above, 10 billion or above. So 40 million to 2 billion, and then 10 billion or above. And that's in the US. The ranges are different in foreign markets, but you don't need to know that. Right? I would also explain the difference between value stocks and growth stocks. Value stocks are low price stocks. They typically are companies that could have some type of financial distress. They might have larger amounts of debt. There might be some other reasons behind it. The behavioral science reason, which is bad news, has come out about the company recently. I had somebody ask a really good question. He's basically emailed me earlier in the he said, if the companies are that bad, I mean, they got bad news out about them, they're more risky, why do they outperform? And the answer is something called migration. A lot of those value stock companies, will turn around and do extremely well. And we call that migration out of the value universe into the growth universe. At the same time, stocks that are performing extremely well might stumble and all of a sudden not perform well and go into value. So you have migration the other way as well. Because of that migration, that's where the extra kick comes. Basically, people might be overestimating how badly these companies are run. That's the behavioral finance side. Or there, in fact, may be more risk associated with those companies because of their attributes. But if we diversify by owning thousands of these companies, then we diversify away most of that risk. Yes, some of those companies will fail. More of those companies will fail typically than growth companies. But we're picking up, because of that migration, all this extra return to offset that. So that's a way of kind of explaining all of these factors, kind of combine them all. So you don't have to repeat 80% here, 80% here, there, kind of combine them all into one phrase. You might also say, we would like you to allocate not just to US stocks, but also to foreign stocks. The foreign developed markets and emerging markets constitute about 50% of worldwide market capitalization. Basically, US stocks are about half of all publicly traded stocks, foreign stocks are about half. You might say in an instance like this that emerging markets countries are in economies that are more likely to outperform in the future than developed markets countries, basically Europe and Japan. Part of that is because of demographics, older populations that are getting even older less population growth in emerging markets, in developed markets rather. Another part is emerging markets are basically transitioning away from economies that are based upon agriculture and exports of commodities to service-based and manufacturing-based economies, and they will see significant economic growth in that area. They also tend to have populations that are younger, not always, but quite often. The result of that, you have a bigger working age population as well. That contributes. So kind of explaining the difference between developed foreign markets, emerging foreign markets, the difference between U.S. versus foreign, explaining the difference that about half of the world is outside. We still have a little bit of a home bias here, 40% U.S. versus 30% international. It's okay to have a home bias because most people feel more comfortable with that. All right. And I think there might be a reason to have a U.S. home bias because the U.S. historically, over the very long term, has been less subject to economic disaster by means of war, for example, by despots, as you might see in some emerging markets countries. And we have a strong culture of innovation and entrepreneurship in the United States that you often don't see in some of the other foreign countries. So I think it's okay to have a strong U.S. balance. Diana, we're going to have real estate investment trust. That's a different asset class in here. It has different risk and return attributes. We know by using that we can actually get a rebalancing bonus as values go up and down by buying low and selling high in all of these asset classes. But because real estate is not perfectly correlated to the other asset classes, we're going to secure a little bit benefit from that. And on the fixed income side, we're going to avoid the use of corporate bonds because corporate bonds have default risk. Even short-term, very high-quality short-term bonds tend to go down in value when the stock market goes way down in value. So exactly when we want the fixed income part of our portfolio to do well in a Great Depression situation or a Great Recession situation, corporate bonds don't do that well. They don't do terrible, but they don't do very well. High yield bonds, by the way, do terrible, but investment grade corporate bonds do poorly, but not terrible. It's much better to have U.S. Treasury bonds. We have a lot less risk there. The chance of the United States defaulting on its bonds is very, very low because of full faith. Basically, those bonds are backed by the full faith and credit of the United States, which means that taxpayers, the ability to tax our people makes those bonds secure. And U.S. Treasury securities are viewed as the safest investments in all the world. We are not going to include commodities because over the long term, commodities have not outpaced inflation by a significant measure. They're also very volatile, as seen recently. We're not going to include hedge funds because their high fees and costs constitute too much of a drag, which lowers their returns. And I'll stop there. You might go a little bit further in explaining those. Of course, those asset classes, the explanations of those asset classes are all set forth later in these documents where I provide the answers to the CPAs. Questions?
So just want to make sure about the like writing the essay part. Like we can like do the handwriting and then we can just upload that picture in the Blackboard with the submitting the Word document.
Yeah, you can handwrite your exam or you can type it, either one.
Thank you.
Yeah, and I wouldn't be surprised if some people are going to type up their answers ahead of time. Now you're going to get one of these three questions. So there's three questions here. I'm not going to change these questions. I might change the expected returns in this chart a little bit, all right? But I'm not going to change the text of these questions. So you're going to have this one where this 35-year-old married couple or the 58-year-old married couple. And I'll go through one of these sample questions in the 7 o'clock session tonight. I'll record that video and upload it as well. I also uploaded another video. I did an announcement on it, exam preparation. It was about 40 minutes, and I did a couple more charts in it. That was a couple weeks ago. All right. Anything else? Okay. I have to hop on another webinar right now, but thank you for joining me today. And if you're not in the evening session, I've had a great time with you this semester and hope you do well on the exam.
Thank you so much, Dr. Rhoades. Really appreciate it.
Thank you all. Now, I just have to figure out how to stop this. That'll be interesting. There we go.
See you, Dr. Ron.